Good morning, good afternoon, depending on your time zone. You can tell I'm not the good-looking guy whose picture's on the cover page here. My name is Pete Knorr. I'll introduce myself a little bit more in just a couple of slides. So today the topic is retirement income planning. And looks like we've got a lot of people interested in retirement income planning today. First, let me spend just a couple of minutes telling you who Bogart Wealth is. So in the investment advice world, there's kind of two categories of advisors. Ones that work for a bank, like they might work for Merrill Lynch or Morgan Stanley or Wells Fargo, and ones who are independent of banks. So our clients, that would be us. We're in that category. We're independent of a bank. So our clients have their funds at a custodian. Charles Schwab is the one that we use. And they give us a limited power of attorney to interact with Schwab on their behalf, buy and sell things in their accounts, move money between accounts in their name. As a registered investment advisor, then we are obligated to be a fiduciary at all times. What does that mean? It means we have to put the client's interest first ahead of our own. If we have any conflicts of interest, we have to disclose those, providing full disclosure, always acting in good faith, never misleading clients, being very transparent about where we're making money, which in our case is only from the fees that the client pays us. There's no way at all that we make any money by, for example, putting you in a Charles Schwab exchange traded fund, as opposed to a Vanguard. And we use both, by the way. So this is our company. Actually, there's a few more people that are so new, we don't even have their pictures on here yet, but the advisors are in the top row. And then everyone else is supporting the advisors to support the clients. We have dedicated portfolio management team headed by Alex Spencer. We have a dedicated financial planning team headed by Sandra Terrence, so that the advisors can spend their time focusing on what is it the clients need, and everything else is going on in the background. In addition, we have a tax team, so we can do tax planning and we can file your taxes if you want. I don't know how convenient it is for you, but we have 3 locations. So started out in McLean, Virginia, just a couple of freeway exits north of Gallows Road, if that means anything to you. When we found that Gallows Road was going to be shut down, started coming to Houston looking for clients. And we now have an office in Houston. That's actually the one that I'm at. And then, of course, we needed to have a campus in the Woodlands. And so those are the 3 locations. Most people still in Virginia. Second biggest office is the Woodlands office. And the one I'm in is our smallest location, but our best. No, I didn't say that. Okay, so our mission as a company is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. So for a lot of our clients, we find that their parents or their children are the biggest uncertainty in their financial plans. And so part of our mission is to help your children or help your parents, along with helping you as the client to achieve that objective. The not so hidden motive of our doing these webinars, these informational webinars, is to get you to come in and talk to us for a one-on-one financial strategy session. Absolutely free, absolutely no obligation, and not at all a hidden agenda. It's right out there. So this is one of a series of seminars that we do, probably the most general, covering everything there is to cover about retirement planning, is the retirement planning timeline. It talks about what you should do 5 years ahead of time when you're getting within the red zone and right after retirement, to be ready for all those decisions you have to make at that point. The one today is, oh, I like it the best. So we're drilling down now into how do you generate income. But Social Security is another topic, tax planning is another topic, estate planning another topic, NUA and other post-retirement strategies, probably most interest just to ExxonMobil employees, long-term care planning, Roth versus traditional, and mega backdoor Roth strategies. And there's another one that's not on the list that we do every month, and that is an update on interest rate, discount rates, for those who are considering the lump sum, and how is it that those interest rates affect your lump sum. Okay, now moving into today's agenda, and I forgot to introduce myself more. So I'm Pete Knorr. Before joining Bogart Wealth, I worked for ExxonMobil for a little over 35 years. I've been with Bogart for, well, since 2013. So what does that make it? 8 years and a couple of months. So I've already done part one, the introduction to Bogart Wealth, and now we'll get into the meat. So first of all, an overview of retirement income planning. What is it? Why is it important? And then our 4-step process that delivers a plan that is customized to your needs, your family. So why do retirement income planning? Well, it helps you think about what are the risks that you're going to face in retirement and help you plan for those and make informed choices about how you're going to fund your retirement. It really helps you to focus down on your expenses, the controllable part anyway, and that will help you have a little bit more predictable future. We can, from that, determine a sustainable withdrawal rate and an appropriate withdrawal strategy. The takeaway is that, you know, managing your investment portfolio while you're in the accumulation phase, really important. But retirement income planning is a different beast than just how do you grow the portfolio. It's fundamentally different from building wealth. Okay, so the first question is, what is it that's going to make your retirement different from everybody else's? And really, no two people have the same idea of what they're going to do in retirement. And sometimes even the two people that are in a couple don't totally have the same vision. And so getting alignment within the family is part of the process. So what impact will your family, I already mentioned, children, parents, sometimes biggest uncertainties. You know, what are you going to do to maintain or improve your health while you're in retirement? And where do you plan to live? You know, are you going to downsize? Are you going to move to a retirement home? And by that, I mean your home for retirement. So basically, that's all part of the process, is helping you to develop a plan for what your retirement is going to look like, what you want it to look like. You know, what activities you're going to be doing. Some people continue to work. Hey, I've already said I retired from ExxonMobil 2013. I'm still working and perfectly happy to do that as long as my brain supports that activity. For some people, leaving a legacy is really important. You know, sometimes it's to kids, but sometimes it's to a charitable organization. You know, really, what is it that you want from your retirement? Now, having said that, here is a list of important goals, and people could choose the top ones. Okay, so you add these up, they add up to a lot more than 100%. People could choose more than one. And if you look at what the top goals were all about, secure, reliable retirement income that keeps up with inflation. So I call this one, don't run out of money. And I call this one, avoid eating dog food. Okay, not worrying about having enough money, being able to help out children and grandchildren. And finally, number 5, we get down to something that's not about money. So even though retirement is about a lot more than just money, forgive me that from this slide on, that's just about the only thing I'm going to talk about is how you want to think about managing your money. Okay, so I mentioned one of the reasons to do a plan is so that you can look ahead and help to mitigate the risks that everyone is going to face. So one risk is that you live a long time. So a lot of times I've talked to a client about their portfolio and they say, but what if I die? And I go, I'm not worried about that. What if you live? Okay, so based on the 2019 mortality tables, and yeah, everything that's happened since 2019 might affect the mortality tables, but okay, that's the latest we have. For a couple who are already, both of them are 65, there's about a 50-50 chance that one of the two of them will make it to 90. So 20% chance one will make it to 95, and there's a 4% chance that one of them is going to make it all the way to 100. So you have to take that into account in your planning. Inflation. So, we've had pretty moderate inflation so far this century up until right now. And now people are talking about, will we have systemic inflation again like we had in the 70s? I doubt that. I doubt that seriously. But we will have inflation. The Federal Reserve is committed to it. We're going to have inflation. So if you just guesstimate a 3% inflation rate and you say you're going to have a 25-year retirement, it's probably going to be more like 30 or 35, but okay. Then in 25 years, basically $50,000, its spending power will be cut in half in that period of time. So you've got to take inflation into account, market performance in general, but the sequence of returns even more important. So if the first few years of your retirement, the market really crashes and you weren't ready for that, that would not be good. And then of course, depending on how your assets are allocated, when you have to sell when the markets are down is not good. So everybody knows the magic of this periodic investment and how as you put money in during the accumulation phase, that volatility guaranteed that you bought below the average price over that period of time. Simple algebra. If you don't believe me, check it out. Volatility guarantees that you bought below the average price if you're putting in the same dollars or approximately the same dollars every month or every pay period in your accumulation phase, dollar cost averaging. The exact same math guarantees that when you're pulling money out during retirement, pretty much the same amount every month, you're going to be selling below the average market price if there's volatility. So how to handle that is one of the things that makes the withdrawal phase fundamentally different from the accumulation phase. And then there's healthcare and long-term care that goes beyond what healthcare insurance covers. Okay, so retirement income planning. We can use historical averages to help us make forecasts about the future, but there's no such thing as an average retirement. So that's why we have this process that will customize and fit your exact goals. Okay, more about that. So here it is as a picture. The first step is retirement analysis. So what is the spending plan? What is the income plan? Forget about how we're going to invest for a minute, use some sort of average rule of thumb for investment returns. Does it fit? If it does, then we can go on to steps 2 and 3. If not, we're going to keep recycling in 1 until we have a plan that works without making heroic assumptions about the investment markets. So then we move into investment strategy and withdrawal strategy. And I'm going to talk about each of these steps. And then it's monitor and review. So you can go to a lot of financial advisors and get a free retirement planning study, paper, set of numbers, but it's never looked at again. So our step 4 is, well, you got to keep on top of this plan. Are we ahead of plan? Are we behind plan? So I'm going to talk about each of these steps now. That is the rest of the presentation today. So step 1, analyzing your retirement needs. I already talked about this a lot, prioritizing your goals, having realistic expectations on how we're going to financially achieve them. And a lot of times it's understanding what the spending pattern will be over your lifetime. So let's say you retire early, before 60. You're still healthy, vigorous. You want to go, go, go. And you're probably going to spend more than you think on extra travel, extra fun. Okay. Then you're going to slow down. Now, when that happens is different for different people, but let's say by 75, you've slowed down a lot. You really want to get your international travel in before that point. And then you get to a point later in life, again, I don't know when, it's different for everyone, but say by 85, you're probably have really slowed down and you want to have all of your domestic travel done by then. So understanding that and budgeting accordingly, that's key. And then having realistic expectations about what are really essential expenses and what are the things that will slow down or at least could slow down over time. And then making sure that you have something extra for things that are unexpected, and also something extra if you have those legacy desires. So a lot of different choices to be made in this regard. Now, this page, it probably doesn't fit anybody who's on the call, but these are good numbers, get freshly updated every 2 years from the government, who does a consumer expenditure survey. And one of the many ways they sort it is by age of head of household. And so here's the group that you could say is pre-retirement. These are people who are early retirement, and 75 plus, these are people later in retirement. And this actually does add up to pretty much the median income in the United States. So you see their spending by category, and you see as people change from sort of late career to early retirement, that what they're spending on apparel, entertainment, food and alcohol, everything except healthcare is going down. And healthcare is going up. And the main reason this is going up is because they're now on Medicare. And Medicare ain't cheap. But compared to a gold-plated plan like ExxonMobil employees have, you're probably not going to see much of an increase when you go to Medicare. But that's the main reason the healthcare went up. Okay, so you see overall their spending was down 21%. And if you say, well, that's over a 10-year period, that's like 2.3% a year. They're sort of eating inflation. And you might ask the question, well, is that because they had to? Because they didn't have enough money to keep up with inflation? Or was that just because they wanted to? Well, there are other studies that have been done that I could point you toward that basically said, nah, that pretty much happens. And with our clients, we see the same thing, that they pretty much eat inflation every year, not because they have to. So people do slow down, and they get to 75 plus, and you see they're slowing down even more in the healthcare barely budged. And why is that? Well, you get to your out-of-pocket spendable, and that's where you are. Down, 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 about the same amount. Okay, so that's just sort of backs up what I was saying before about as you age, you're probably going to spend less. So we'll help you make the inflation assumptions, and we're generally going to assume that healthcare is rising faster, much faster, almost double the consumer price index. And then you might want to build in extra costs for later years, or you might want to consider long-term care insurance. We're not insurance salespeople. We will help you to find long-term care insurance if you want, but we don't sell insurance. We just can help advise you on it. Okay, so identify your income sources. We're going to talk about these some more. And, you know, again, the whole idea is to determine, does the plan work? Do all of the spending wants fit with the amount of assets available, the income available to support that? So your primary sources of income are going to be Social Security, pension, and then whatever else you might have saved, put aside for it. So Social Security could replace as much as 90% of your working income if your income is sort of at or below the minimum wage. It could be less than 1%. We'd really love to talk to you in that case. That means your income is so high that the first 150,000 of it is pretty negligible. For the median income in the United States, Social Security is replacing about 40% of their gross income that they had when they were working. Exxon doesn't like us to use their name, so it says for a typical oil industry employee, it's going to be in the range of 10% to 30%. So 10% is like an executive, 30% is like a paraprofessional. That comes from this curve. So this curve, even though I have a source that says it from the Social Security, the data is from the Social Security. This curve, we've never seen anybody else think of it this way. So if you think of it in terms of an income replacement ratio, and on this axis, it's as a percentage, your income being your pre-retirement gross income being a percentage of the maximum covered earnings, then the curve stays the same. The percentages stay the same every year. The only thing that changes is these absolute dollar amounts, and the absolute dollar amounts change based on the changes in the median income of the United States, which right now is 72,000. Okay, and the 100% maximum coverage, or you stop paying Social Security payroll tax, is at about double that. And then at about 1/8 of that is where you are at this first, what they call bend point. So it's replacing 90% up to the first bend point, and then 32% down to the median income. So right at the median income, your 42% replacement rate. 15% replacement up to the maximum covered earnings, and after that, they're not covering you at all. So it's zero, so it's going to asymptote to zero, but it takes a long time to get there. So that's Social Security. You can kind of find yourself on this chart, and you can see how much Social Security will replace your income. I know it's going to beg a question. And by the way, I have the Q&A open and I have the chat open. So if you have questions as we go along, go ahead and pop them there and I'll answer them as I can. But you can kind of find yourself on here and see what your replacement rate is going to be for Social Security. And I know there's discussions about will Social Security be there. That's in our Social Security seminar. So I really don't want to address it here. The short answer is yes, it'll be there, but you probably need more than just that if you're worried about it. So number 2 is the pension. And these comments are definitely aimed directly at the ExxonMobil pension. So it's a fixed annuity, which you could take as a lump sum. And as an annuity, it's going to replace somewhere between 12 and 65% of earnings. So that's a pretty wide range, but consider that you can start at 55 and 15, or you could still be working at 65. And have 45 years or something with the company, right? So the annuity depends on age, service, Social Security. So it's pretty simple formula, 1.6% times years of service times, says average pay. Final pensionable pay, which is the average of the last 36 months, unless you left on disability or restricted duty, and therefore it's not really the last 36 months, it's the highest 36 out of the last 10 years. And then they subtract off the Social Security offset. So in other words, you were paying into Social Security while you're working, your employer was paying into Social Security while you were working, and they want their half back. Okay. It's a little bit more complicated than that, but it's basically, that's the idea. So for the typical career employee, so they started in their early 20s and they leave at age 60, it's going to replace about 50%. I've got a nice picture for that too. So this is the career employee at 55. They started at 22, right out of college. Then they've been there 33 years. And so every year that they can continue to work, they got 2 factors working in their favor. One is, you get 100% of the vested amount at age 60 and a 5% haircut for every year before age 60. So they've got a 25% haircut going at 25 versus 60. The other thing you get is another year of service. One more year out of 33 years is 3%. So 5 plus 3 is 8. You're going up by about 8% a year, even without a salary increase, as you continue to work between 55 and 60. Okay. After that, there's the 5% drops off. You only have one more year. Now, that 3% is overstated. 1 over 40 is 2.5. Okay. So up to here, it would round up to 3%, and past there, it's going to round down to 2%. Okay. This curve looks completely different. This is somebody who started much later in life with the company, and they're leaving at 15. Okay. So no matter when they leave, they left at 15 years. So they're not getting anything from one more year. But if you think about it, somebody who's been there 15 years, one more year of service is like 5% more percentage-wise on their annuity. Okay. Now, convert that to a lump sum. Okay. You want to go to the monthly seminar we do on how interest rates affect the lump sum. So right now we're just talking about as an annuity, because again, we're just doing one of these range finding with the plan. Does what you want to spend fit inside the bucket? Doing it with a pension replacement this way is a lot simpler to conceptualize. So, okay, that's, again, you can find yourself more or less on those curves and know how much the pension replaces. So let's say you're this person and it's replacing 50% at age 60. And let's say you're right in the middle here, 20%. That's 70% of your income. It's not as bad as it sounds, because you're paying almost 10% a year in payroll taxes between paying into Social Security and paying into Medicare. That's almost 10% right there. And then, of course, you're saving for retirement. Okay, so you don't necessarily need 100% replacement to have an equivalent lifestyle in retirement. But yeah, you probably do need some extra savings. And the other thing is that if you're retiring before Social Security age, which almost everybody is, then, well, you need something to fill that gap until you get to Social Security. So the savings and investments becomes really, really important. Okay. So once we have a plan that works, we can now start talking about part 2, investment strategy, and part 3, withdrawal strategy. And I really like to talk about these two together, but it's hard to do a webinar that way. So let's start with investment strategy. What I've listed here are a handful of strategies. And it says down here, you might have multiple elements in a comprehensive strategy. But let's just make sure we understand what these are. So annuities is the only one you can use the word guaranteed. So it's the lowest risk category on here. There's 3 types, and I'll talk about them in a minute. Bond ladders, so investing in a series of individual bonds. I'm going to show how that concept works. Ever since 2008, interest rates have been so low that I don't have a single client who has a bond ladder as an income strategy. I have some who have bond ladders, but it's not really part of their income strategy. They got there by some other method. So the main 3 here to think about are income-oriented investments like dividend-paying stocks, preferred stocks, master limited partnerships, fixed asset allocation, and dynamic asset allocation. So I'll talk a little bit about annuities and bond ladders, and I'm going to talk a lot more about these other categories. However you set up your investment strategy, you want to be sure that you've already planned for what's going to happen if, because reacting to something you had not planned for is more likely to be emotional than rational. So fear and greed lead to people buying high and selling low. And I'll tell you, fear is the bigger factor than greed, because you can be greedy and at the same time in the back of your mind go, oh, I hope this works out. But when you're fearful, there's just, that's all. It takes over all rational thought. Okay, so we want to help you develop a foundation, a strategy that's going to deal with the fact that the world is not perfect. All right, back on topic. There are 3 types of annuities. So the one that the company offers in the pension plan, and by the way, if you're thinking about annuity, I'd say think long and hard about taking that one. It's a better deal than you're going to get anyplace else. But okay, there's some things people don't like about it, and the big thing they don't like about it is that it's fixed. And you know, you can think of it like a bank CD. It's going to be very, very reliable, and it's held in a general fund. What does that mean? That means that you don't have your specific investments with your name on them. If the insurance company fails, you're kind of in line with a bunch of other people trying to get what was promised to you. But you should not worry that much, because if it's the company annuity it's triple backed. It's backed by the company itself. If they dry up and blow away, the pension plan is a separate entity. And if for whatever reason they mismanaged the money and went into receivership, there's the PBGC there. So it's kind of, you got two backstops. The PBGC is not a perfect solution, but it's certainly better than having no backstop. If you buy from an insurance company, each state has a fund like that PBGC. And the states don't want you to rely on that 100% either. So it's not a perfect backstop, but it's pretty good. Okay, let's jump over to variable annuities. So back in the 70s when inflation was high, all of a sudden nobody wanted to buy a fixed annuity anymore. The insurance industry had to come up with a solution. So they came up with variable annuities. It's a lot like having a mutual fund inside an insurance contract. In theory, you get the rate of return of the market. The reason I say in theory is that the insurance companies are really good at dangling in front of you optional riders that you will fall in love with and be willing to pay, oh, just, you know, a small fee every year. And it pretty much makes it so the variable annuities really stink and you never get anything like a market return in a variable annuity. But one good thing about it is a separate account and you still have your securities in your name inside that account. So even if the insurance company goes under, you have something, but it's been eaten away by those fees all those years. So, okay. So people got unenamored with variable annuities because of that. And so the insurance companies had to come up with something. And so the latest baby is the indexed annuity. And honestly, I think of the three, I like this one the best. But again, I'll go back to, if you're thinking annuity, think company annuity. We'll be happy to talk you through that. Bond ladder. So this is an oversimplified example that's just showing 3 rungs with 3-year bond ladders. So, you know, most of the time you're going to see something more like 5 to 7 rungs on a bond ladder. And I can explain why some other time, because right now I'd say interest rates are too low to really be thinking about this. But when you first set it up, you'd buy a 1-year, a 2-year, a 3-year bond or bond fund. And then when year 1 matures, you're going to take that money and invest it in a new 3-year. And when the 2-year one matures, you're going to invest it in a new 3-year. Okay, now imagine that with 5 or 7 year, and you're getting like the return on a 5 or 7 year bond. Well, right now that's still not enough to live on. Okay, so that's why bond ladders are not that popular now. But the idea would be you're creating income that as long as you never touch the principal, you can never run out of money. All right, so now we're switching from bond ladders to more generically, how do we create an income portfolio that could be like preferred stocks, where you might be able to get 5% dividends per year, or royalty trust. Now look at this, some of these, the outlook for some of these oil royalty trusts is so bad that they're paying these ridiculous amounts. And the only question is, yeah, but how many more years will you be actually able to get that? Okay, dividend paying stocks, 3% is fairly easy to find. Good blue chip kind of companies. If you're willing to take more risk, and this is particularly in sort of the oil industry, and particularly the midstream pipeline companies, Magellan Midstream Partners, Enterprise Products, Marathon Pipeline, these guys are paying dividends that are still over 6%. And you compare that with what you could do on bonds. So if you build a bond ladder with treasuries using iShares bonds, it's got a 0.8% yield. If you did the same thing with corporate bonds, iShares, 1.3. You go to junk bonds. Oh, I'm sorry, high yield bonds. It's only 2.6. Okay, so clearly in today's environment and for the last decade, the answer has been no, we're going with dividend paying stocks. And the difference between a preferred stock and a regular dividend stock is, well, a preferred stock has a higher claim on those earnings, but it's much less likely it's ever going to go up. There's no incentive for a company to raise dividends on preferred stock. So the common stockholder is the ones that are getting dividend increases over time. And here's an illustration of that. Now, I've been using ExxonMobil as my example for many years, and maybe I'm going to have to change that. But okay, for now, the idea behind this is when I was a puppy at Exxon, some old guy took me aside and said, Kenora, this is the way you do it. In your savings plan, you put all your money into ExxonMobil stock. And when you retire, you take the annuity, and you're going to find that the dividends on the ExxonMobil stock, along with the annuity, is more money than you were making while you're working. And the pension doesn't go up with inflation, but the dividends do. Up until this last year, that was pretty true. In fact, it's kind of old that I pulled this down, but found on the website a couple of years ago, ExxonMobil dividend payment shareholders have grown at an average rate of 6.1% over the last 38 years. Makes me wonder what happened 39 years ago. No, I know what happened 39 years ago, but let's just say that's the point, is that their dividends go up every year. So if you bought $100,000 of ExxonMobil stock back in the year 2000, they were paying a paltry dividend of 2%. You would have got $2,000 back. But that dividend has increased every year until, well, last year it was flat with 2019. Well, actually, it was up a tiny bit because you got the increased one for 4 quarters instead of 3 quarters. We have an alternative, the prime income portfolio. If you put $100,000 into it back in 2000, it was paying a little over 4%. So you'd get like $4,200. It's not one stock, so it's not monotonic. And some years it actually goes down. So 2008 to 2009 dividends were down, and 2019 to 2020, they were down substantially. Okay. But if you sort of draw this curve through it, you're getting a 7.2% compounded growth. And if we weren't charging you fees, you get even higher growth, like 8.2% on just the stocks themselves. So that sort of illustrates an income-oriented dividend income strategy. So that's one strategy. I would say it's a minority opinion to go that direction. So most people in the world are going with a sort of a fixed asset allocation. And this is called modern portfolio theory. But I would run from any advisor who tells you they're going to use modern portfolio theory to manage your account, because modern portfolio theory requires you to know the cross-correlation coefficients among all the different asset classes that you're going to have in your portfolio, not last year, but next year. Okay. And I would posit to you that if you know those correlation coefficients for next year, why don't you just buy whatever's going to do the best? forget about this asset allocation thing. You know the future. Okay, so they don't know the future. And so the idea of fixed asset allocation is fine. It's beautiful. It's wonderful. But charging you money to do hocus pocus, that's not wonderful. Okay, so the basic idea is that year-to-year variations are going to cause your returns to be higher or lower than expected. But if you average things out over time, and in this example, I'm averaging out from 1980 to 2018. And the way I'm showing this is, what was your worst year, your worst 12 months? How much money did you lose? And then I'm showing it at different mixtures of a bond portfolio, 100% bond and 100% stock. This, by the way, is exactly the same bond index that is the bond units in the savings plan. And this is the exact same equity fund that is the equity units in the savings plan, and mixing them at different proportions. Okay. And a lot of people think that bonds are the safest thing, but they're not. Adding stock to a bond portfolio decreases the probability of losing money in any given year up to a point. And that point I'm showing is 40% stock. Other people do the analysis a different way, or using data from a different period, and they come up with 35% stock. So 35 to 40% stock is your lowest risk fixed asset allocation portfolio. As you add more stock to the portfolio beyond that point, you're now, the expected return is not going up as fast, and the expected loss is now coming up. At 60% stock, you have about the same risk as you would with 100% bonds, with a lot higher return. A lot higher return. So this is a very popular stopping off spot for people in retirement. It's kind of a 60% stock, 40% bond. Somebody who's highly conservative, I direct them to the inverse of that, 40% stock, 60% bonds. That's the idea behind fixed asset allocation. Now, if I go back to an income only sort of strategy, either with a bond ladder or with dividend income, as long as you never sell anything, you cannot possibly run out of money. If you're just living off interest, you're just living off dividends. So that's a good thing about that strategy, or those strategies, is that it guarantees you you'll never run out of money. What it doesn't guarantee is that you'll have enough to live on. Okay. This strategy, fixed asset allocation, implies that every year, some people do it more than once a year, you will rebalance back to these ratios. So in a year where the stock market goes up 10%, 20%, and your bonds are only giving you 2%, 3%, then the stock portion is going to get bigger. You're going to have to sell some stock and buy some bonds to get it back into balance. Okay. The act of rebalancing guarantees you will never buy stock at the top of the market. Okay. And when stock market starts to fall, you're supposed to be selling bonds and buying stock to keep it equal. Not every day, but over time you're supposed to do that. And that guarantees you're never selling stock at the bottom of the market. So what fixed asset allocation does is guarantees you avoid the two biggest mistakes that people make in investing their money. That is buying at the top and selling at the bottom. So this will force you to do the exact opposite. And I just have to say asterisk and footnote, if you can stick with it. So that's the problem, is that sometimes people have a little trouble sleeping at night when like a March 2020 happens. and they just have the urge to, I want to be safe, I want to sell. So if you stick with it, this is a great strategy. So what is dynamic asset allocation? Well, yeah, I like this quote, but we don't need it. Basically, what dynamic asset allocation says is, we can go back to the 1880s and we can see that just about every decade we had a multi-year period of time that the market was going down, 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 down. Okay. Here it was 4 years. Here it was 6 years, 2 years. Well, that one, yeah, okay. 5 years. So every decade, except when you and I were in our formative years learning about investing in the stock market. So in the 80s and 90s, I'm not saying we never had a decline. Yeah, we definitely did. We had a double dip recession when Reagan was president. That's what they did to wipe out inflation, if you remember. So we had market declines, but not multi-year declines. And why am I emphasizing multi-year declines? Because I said back here, we've got to rebalance this every year. Some people do it more often, but every year. So if every year for 5 years, you're taking some of your safe money and putting it at risk and it goes down some more, you could lose religion. Okay. And so that's one of the problems with fixed asset allocation. And that's kind of part of what dynamic asset allocation is trying to overcome. So dynamic allocation is not trying to time the market. It could be as simple as, as long as the market's going down, we're not going to try to catch a falling safe. We're going to kind of wait for it to bounce on the bottom a few times before we go in and rebalance. Okay. It could be as long as there's not a cloud on the horizon, let the winners run. Okay. Only once you start to see a few clouds gathering on the horizon, all right, now let's rebalance and sell some of that stock and get back into balance. Okay. So basically, you're watching flows of funds that are creating these market price trends. Now, this is not just trend following. But it's like if you were trying to build a model, it would have to take into account everything in the world, including things that have never happened before. But if you got some reality in it of yes, but what is the market actually doing? Well, that will help you find things that a model was never expected. Okay. So you rank your asset classes based on their relative strength, and then you align your allocation to the strongest asset classes. This is just for illustrative purposes. This has almost nothing to do with how we manage using a dynamic model, and you can't read it either. So just look at the colors and the idea that things that were at the top in 2001 were dropping and dropping for 2003, 4, and 5. Okay. And then coming back up and back up. So there are sort of cycles to markets, and that if you're tracking these things and you can move fast enough, you can avoid at least being in the wrong thing 5 years in a row. Okay. So that was talking about how to align your assets. And I said it really needs to go hand in hand with a withdrawal strategy. So a withdrawal strategy can be income only. And I've already mentioned this. If you're just living off of interest and dividends and you never have to sell anything, you don't really have to worry about market crashing. Your income will still be coming in. Okay, admittedly, if you had BP stock, and they had a really nice dividend in 2019, they cut their dividend in half, okay? Or Shell, they cut their dividend by 2/3. So not always is all of your income completely stable and you don't have to worry about anything ever. But for sure you're not running out of money if you have a diversified portfolio with dividend and interest income. You will never run out of money. What it does not guarantee is you have enough to live on. If you think about systematic withdrawals from a balanced portfolio, so that is your fixed asset allocation approach, or it could be a dynamic asset allocation approach. And you have one well-balanced portfolio, and part of your process for keeping it balanced is I'm taking the money out of the stuff that's going up. Okay, that's part of your rebalancing process. So you're not selling stuff that's crashing. You're always taking your money out of whatever it is that's going up at the moment. But again, what I mentioned is it's sometimes hard to keep that religion. And so the bucket approach is kind of an intermediate that addresses the difficulty in sticking with the religion on systematic withdrawals from a well-balanced portfolio, but gives you more flexibility than the income-only approach. So this is an example of it. In this example, a person has $1.5 million and they need $60,000 a year income out of that. So we put this into 3 buckets. This is simplified, okay? So in bucket 1, we're assuming no returns. You need $60,000 a year, 5 years. You need $300,000 to come out. So we're going to put $300,000 in. We're going to put it in really stable stuff, cash, bank CDs, maybe laddered bank CDs, maybe some high grade bonds. So maybe they get a little bit of return, but certainly it's not going to keep up with inflation. Okay, bucket 2. To account for inflation, we bumped that $60,000 a year up to 70. Say it's for 7 years. We need $500,000 to come out, but we can count on some growth. So we put $400,000 in. This might be that lowest possible risk of stocks and bonds. So it's 40% stocks, 60% bonds. They're not all short-term bonds that are very, very stable. So you're taking some interest rate risk with the bond side, but that means you're going to get a little bit higher interest rate. That's bucket 2. And you could say everything else is in bucket 3. But for people who have even more money than that, that they're never going to spend and they're growing it just for their kids, there could be a 4th bucket out here for that. So here in bucket 3 is your remaining years of your planning. And we've bumped up the income needed again to account for inflation. So you need 1.2 million, but again, you can count on some growth. So you put in 800,000. So we're basically saying we're going to get a 50% increase in that 800,000 over a 13+ year period of time. A 60-40, 60% stock, 40% bond portfolio over the last 10 years, doubled, more than doubled. And that's 10 years, not 13. So that's conservative to say that you'll get that kind of a return if you leave the money alone long enough. And the idea is that if the market crashes, you close these valves. When the market's doing well, you're replenishing the buckets every year. Okay, so that's 3 different withdrawal strategies. And I said only the income-only strategy guarantees you won't run out of money. So to kind of know you're going to run out of money with the other strategies, of course, we do a financial plan. But here's a good rule of thumb for you. And it's saying how long before you run out of money at different initial withdrawal rates. So the withdrawal amount is going to go up every year. So let's take the 4%. If you're starting with $1 million, 4% of that, 40,000 a year that you can withdraw from the portfolio. And if you're getting a 3% real rate of return, so the difference between inflation and your investment return is 3%. Then that portfolio under those rules is going to run out of money in 43 years. Now, I would submit to you that in the last year, that was 100% withdrawal rate. So it starts at 4, but about 15 years into this, it's grown to 5, okay? And then it's grown to 6 and 7 and 8, and it's going exponentially. So if you're 60 years old, that's pretty safe. You make it past 100, okay? 5%, if you're 70, 5% is safe. You'll make it to 99. 3% might look like it's going to the moon, but it's not really. It's going to flatten out. It's going to crash over here at about 101 years. So I would say 3% is safe for a newborn, 4% is safe for a 60-year-old, 5% for a 70-year-old, et cetera. And looking at your withdrawal rate is one way to help you understand, am I okay in my bucket? Am I okay in my systematic withdrawals? Can I afford this new thing I want? What would that do to my withdrawal rate? Okay, so that's sort of how you marriage up your withdrawal strategy with your investment strategy. Now, another thing is, okay, so I've got pre-tax accounts, I've got after-tax accounts, and by the way, I've got Social Security that I can start at 62 or wait all the way till 70. Okay, so what do I draw on first? Well, the rule of thumb is you're going to draw on your after-tax accounts first. You're going to minimize your taxes in the early years as much as possible. You're going to pull in your qualified accounts next, and you're going to leave your Roth accounts. They're growing tax-free. Leave them as long as you can. It's not always the optimum, but that's kind of the going in basis. We see what it looks like for taxes and we react to that. You're going to have required minimum distributions at 72. It's going to force you to withdraw a certain percentage each year. The percentage increases with age. You can always take out more than you want. But if you fail to withdraw your RMD, the tax penalty is 50%. So we look at this. This is the existing distribution. This is one that's been suggested, but it hasn't actually passed Congress yet. And it doesn't really make a whale of a difference until you get to like 105. So we don't really care which one of these we're on. Look at either table you want. At 72, it's 4%. So it's a very safe withdrawal rate. But it's going up exponentially, okay? Because the idea is they want you to not leave money. Okay, so it gets up to 50% or over 50% under the existing law per year. Not that many people live that long. So this is an example where this is their spending plan, and it includes taxes, and they're paying very low taxes in their first years. This blue is their income, so it looks like they probably have an annuity. And then one of them starts Social Security. The second one starts Social Security. So here's the annuity and Social Security. It's going up because of Social Security cost of living allowance. The purple is other withdrawals they had to make. So right here, when they're both on Social Security along with their annuity, they're pretty much flush with what their spending plan is. And all of a sudden, they have all this savings, and they have to start withdrawing from it. And the reason the spending line jumps up is because increased taxes. And you see how it's going up exponentially because these required distributions are going up every year and they're being taxed, and they're pushing them into higher tax brackets. Okay, so in this case, we said, well, they have these really low tax brackets here, 10% tax bracket for the first 4 years of their retirement. What if we did Roth conversions, voluntarily paid a little bit more tax, and that would pull money out, reduce the required distribution? So this is what they look like in the base case. they ended life with, well, they did have a tiny Roth, but they ended life with 12 million bucks, 12.8 million. Almost 5 was in after-tax accounts. So they had spent down the after-tax accounts, but they came back because the required distributions were so high, they had to pull out more money than they were actually spending. Okay, so we looked at doing Roth conversions. You see between 150,000 and 200,000 a year for those 4 years where they had low taxes, and significantly more money ended up in the Roth, 3 million now, but they ended up with more money overall. So their taxes were higher earlier, but lower later. So basically, that was able to bring down their required distributions by pulling money out of the accounts that were going to have to do the required distributions, putting them in a Roth that has no required distributions. So yes, they paid higher taxes than they would have. By the way, we're calling this the bump case because we're bumping up against the next tax bracket. So yeah, they had to pay higher taxes in here, but it saved them significantly on taxes later on. So here you can see they went from would have been a 3% effective tax rate to a 16% effective tax rate. So anyway, tax planning is a huge part of having an entire financial plan for your retirement. So it's not just investments. It's not just a withdrawal strategy.
I didn't get that. Could you try again?
I think Siri thought I was talking to her. It's not just investments. It's not just a withdrawal strategy, but also tax planning. And you can.
I don't know what you mean by. I think Siri thought I was talking to her.
Okay.
It's not just investments. It's not just a withdrawal strategy, but also tax planning.
I can't believe she repeated that word for word. Okay, so so you can see ordinary income tax rates always higher than capital gains rates. That's part of the planning. So step 4, the last step, monitor and review. So basically, as the world turns, assets are either going to be better than projected or worse. Income, like you saw in the dividend income approach, it dropped from 2019 to 2020. So it's not always going to be what you expected. Your spending is not always what you expected for sure. And portfolio returns. So basically, we need to re-engage with the plan from time to time. And okay, so creating your paycheck, basically starting with some initial assumptions about withdrawal rates, understanding what the withdrawal strategy is going to be for the discretionary items. Things don't always have to go up with inflation, and sometimes they can go up even faster than inflation. So having a plan will increase the probability of success. These are different strategies that one can employ based on when the unexpected happens. In short, we think you really should have a plan. We're really happy to develop it for you. And our advising, our planning, our strategizing, our running different tax scenarios is always free. So the only thing we ever charge for is if you want us to manage a portion of your portfolio. That's how we make our money. So hopefully I spoke in an understandable way today. Hopefully some of you will want to come in and have a conversation about this. I didn't update this slide because you can find this stuff online under bogartwealth.com. Go to events. Under that is video events, or you could just go directly to this link. all of these presentations, almost all of them, get recorded and put up on the web. So, if you missed something today, you can listen to it again, or you can tell your friends to check it out here. You can sign up to know about the future events. So on this video events page on the right-hand side, this doesn't even ask for your phone number. All we're going to do is send you an email about future webinars. Don't worry. Or you can go to the contact us if you have a more specific question, but here we're going to ask for a phone number if you use this one to sign up. And that's it. So I have on this page numbers for myself, for James Bogart, some of the other advisors, and also for Mindy, who schedules all of our calendars. So if you want to meet with any one of us, please do. And I didn't get a single question today, but if you have any questions, I'll hang around for a little while longer and answer any that you might have. Thank you.